All right, folks. Now, rising bond yields from Trumpian growth, not Trumpian inflation. And that's the subject of the riff. Now, bear with me on this. We're going into the financial markets. Please, folks, let's not start panicking about a little bit of an increase in long-term Treasury bond yields. Last couple of weeks, I've seen more ink spilled about the 30-year Treasury bond than I have in probably the last 10 years. The bellwether Treasury is the 10-year, which has been trading steadily and calmly in a range of maybe 4 to 5%. No one's been screaming about that. But here's the key point. Okay, the 30-year Treasury has gone up about 30 basis points. That's it, okay? In recent weeks, because really lots of new economic statistics show a faster and more powerful growth rate in the economy, especially manufacturing and construction and advanced technologies. That's the story. It's about growth. It's not about inflation. But of course, the news headlines screaming inflation with no decent analysis because they love to keep whacking away at President Donald Trump. Take a look at any of the Treasury rate increases, by the way. Go ahead across the board. You'll see it's all from the real yield, not the inflation component. Now, the inflation component, which is the CPI break-even compensation for inflation, that has not gone up all year. The break-evens have not gone up. For example, let's look at the market rate for 10-year Treasuries. It's increased about 50 basis points this year to date, all right? All of it is from the real yield from TIPS. The CPI break-even component that implies inflation has basically been flat. The same is basically true for the 30-year Treasury bond. What's happening, however, is that market rates have been driven up for stronger 4% type economic growth. And they're normalizing after all the zero type interest rates from the financial crisis and from COVID and from very bad Federal Reserve policy that new Fed head Kevin Warsh is going to fix. And actually, how about some context? A 4% plus Treasury yield is really more like the Bill Clinton, Newt Gingrich days, that was the 90s, of strong economic growth from lower capital gains taxes and welfare reform. The economy was booming. Actually, the Treasury rates were around 6%. So right now, we're just normalizing around 4.5%, and yeah, the 30 years above 5%. But there's an enormous boom going on. In fact, here's Mr. Trump on the boom, which I believe emanates from one big, beautiful bill. Take a listen.
We've gained so much in the last 16 months like nobody can believe, actually. Not only that, but we have more money being invested in the United States than any country at any time in history. Money's coming in by the trillions. Our nation's economic dominance drives trillions of dollars in investments, creates millions of jobs, and expands access, credit, and capital so that every citizen has a chance to achieve what we now hear a lot about, the American dream.
Very important that he said that. The American dream is alive and well. So I'll just put a cap on this by saying, first of all, ignore the headlines. Second of all, interest rates in the bond market are not exploding. And what increase there has been is because of a stronger than expected economy. And we are normalizing, and there's nothing to panic over, even though the media loves to whack away at Mr. Trump on almost every topic under the sun. And that's the riff for tonight. Okay.